We're going to work on Brewster. First thing they want to know is how many units must be sold to break even. So what is the formula for break even? Break even per unit. It's fixed cost divided by the contribution margin per unit. They don't give us the contribution margin per unit, so we're going to have to build it. We've got the sales price, we've got 4 variable cost and then fixed cost. So I put the fixed cost in here already. So let's build the contribution margin per unit. So I'm going to get the sales per unit, your total sales divided by the number of units. And I can do the same thing for each of my variable cost. So I can build my contribution margin per unit. They don't give us the total here so that we can divide by 180, but they tell us it'll be 5% of sales. So that would be 0.05 times the number. Alright, so now I'm ready to do the math. Sales price minus my 4 variable cost. And there's my contribution margin per unit. I put it in my denominator and it calculates for me the number of units I would need to break even. Now in B, it wants to know not just how many units to break even, but how many units to make $40,000 before tax profit. Alright, so let's get that formula. So if you want a target in addition to break even, you add the target to the numerator so that you get enough units sold to cover both the fixed cost and the target profit. So I've got the target profit added to my fixed cost here, same contribution margin per unit, and I have to sell quite a few more, of course, to meet a profit than I do just to meet break even. Now in C, they want to know how many units you've got to sell to earn an after-tax $40,000. That means after the 20% tax is taken out, you want $40,000. So you have to earn more than 40 so that you're left with 40 after the IRS takes 20%. So we convert an after-tax number to a before-tax target, and then we can put it into our formula. So you convert an after-tax target to a before-tax target by taking your after-tax target and dividing it by 1 minus the tax rate. So here, our after-tax target is $40,000. And I'm going to divide it times by 1 minus the tax rate. The tax rate is 20% or 0.2. So 1 minus 0.2 would be 0.8. And so 50,000 is the before-tax target that will give me an after-tax of 40,000. So now I can put it into my formula and calculate. Here in the numerator, I have my before-tax target that will give me my after-tax 40,000, my contribution margin, so it will take even more units to get to this new target. What about D? D is not asking about units. D is asking about sales revenue. How much sales revenue do you need to earn $90,000? So instead of having the contribution margin per unit in the denominator, we need the contribution margin ratio. Let's do that now. So I've got to compute the contribution margin ratio because I don't already have it. My numerator is the fixed cost plus my 90,000 target. So my contribution margin ratio would be the contribution margin divided by the sales price. And so the revenue to achieve that 90,000 target would be 2,200,000 revenue, not units. That's revenue. E, what are profits if variable costs increase 20%? So we have 4 variable costs. And so if they go up by 20%, they're this new number. So let's inflate them all by 20%. The sales price didn't change. And so the new contribution margin will be $544. So they want to know what will the profits be at this new contribution margin with the inflated variable costs. So let's create a little contribution margin income statement. Here we go. I've created a line for each of my 4 variable costs. I put the fixed cost in here. So now the sales revenue is the $16 times the units, Okay, so that didn't work. Try that one again. You gotta love Excel, but you have to hit the keys right. Okay, direct material times units made, labor, the new inflated costs. That's quite a cost increase, isn't it? And last but not least, the higher variable selling. So that's the total there of all the variable costs added up, and our contribution margin would be sales minus our total variable cost, and then subtract out your fixed costs. So that is your operating profit after the 20% increase in your variable cost.